So the topic for tonight is foreign exchange rate systems and calculations. So let us first discuss the overview of the exchange rate systems, and then we'll go for the calculations. All right. Currency exchange rate systems and calculations. Now, whenever you purchase something in international context, maybe you purchase a capital asset from a foreign country, or you might have some financial instrument like a bond, like a share in a foreign market, right? So if you have purchased a capital asset, or if you might have purchased a financial instrument or financial asset like bonds and shares, the person from whom you have purchased this capital asset or the financial asset, he wishes to be paid in his domestic currency. Means, let's say, if you have purchased a machine from American company, that company wishes to be paid in dollars. Or maybe if you have purchased bonds and shares in the US business, your broker wants the payments in domestic currency, in dollars. Clearly, that what his preference would be. So then what should I pay? I have to use my local currency, and I will convert that local currency into the foreign currency and only then pay. So let us first define what is exchange rate. Now, right now, $1 is approximately 176 or 75 PKR. This is what you call the exchange rate. The price of one currency in terms of another. $1 is worth 176 PKR, or you can say it in another way, 1 PKR is equal to 1 over 176 US dollars. So one way or the other, this is what you call the exchange rate. So exchange rate can be defined as the price of one currency in terms of another currency. This is the exchange rate. Price of one currency in terms of another. So when you purchase a capital asset or a financial asset from whoever you have purchased the financial asset or capital asset or any other service maybe, you would be required most probably to pay in the domestic currency of the seller. What you should pay depends upon the exchange rate between you and your seller's currency. This is what you call the exchange rate, price of one currency in terms of another. I remember, as far as I can remember, the exchange rate of US dollar to Pakistan was rupees 20 many years ago, more than 20 years ago. Right now, ladies and gentlemen, $1 is about 175 PKR. Now, how do we interpret this? What has happened over the last 20 years? A complete destruction of economic system. That's what you can see. $1 was worth 20 rupees, and now $1 is equal to 175 rupees. What has happened over the period? We can say over the period, dollar has strengthened, dollar has become stronger, and rupee has depreciated. Rupee has lost its value. Dollar has become stronger. Now $1 is worth 175 rupees. Previously, $1 was equal to 20 PKR. So over the period, over the last 2 decades, dollar has strengthened in power. It has become stronger. I won't say 20 years ago. I would say it's about 27, 28 years ago. I'm talking way back 1993, 94. Things have gone very wrong over the period. So when a currency becomes stronger with reference to another currency, we say it has appreciated. The currency that has lost its value is called it has depreciated. Let us discuss this in specific terms. Currency appreciation, when a specified amount can buy more units of another currency. Now your $1 can purchase 175 PKR. So we can say $1 is appreciated. And on the other side, look at from the other side, you can say that PKR is depreciated. The currency depreciated when a specified amount can purchase fewer units of another currency. $1 is equal to 175, means dollar has strengthened. On the other side, now we have to pay more Pakistani rupee to buy dollars. So you can say Pakistani currency is depreciated. So just put it simply. In other words, just for short, depreciation in A's currency in PKR is an appreciation of the currency of country B, that is USA. So if one currency depreciates against the other, that means the other currency appreciates. You can see both of these pictures in a single dynamic. $1 is equal to 175. Now, how does it affect international trade? We'll discuss that in later. Here we just learned what is exchange rate, what is exchange rate appreciation, depreciation. Okay, here I would like to give you an idea regarding the difference between depreciation and devaluation. We will discuss it later, but let's put it in the right perspective right now. Exchange rate appreciation and depreciation, it takes place with reference to economic fundamentals with regard to trade between the countries. It's based upon the economic factors. Depreciation and appreciation is based upon the trade between the countries. But when you call devaluation or revaluation, this is done by the central bank. This is done by the central bank, like State Bank of Pakistan, like in India, Reserve Bank of India. These are the central authorities that determine what the value should be of dollars in Pakistan or in India. So remember, depreciation, appreciation occurs on fundamental economic factors with regard to trade between the countries based by the market forces, whereas devaluation and revaluation, this is done by the intervention of the central bank. We'll discuss this detail as we go along in our lectures. Okay, now a little bit about fixed and floating regimes, fixed and floating exchange regimes. Some countries, in order to avoid exchange rate volatility, like Saudi Arabia, they have fixed their currency against the US dollar, like $1 is equal to 3.751 maybe. This is the exchange rate. $1 is fixed. When I was there about 20 years ago, it was there, and I think still now, Muiz can tell us the rate is the same almost. This is called the fixed exchange rate. In order to avoid exchange rate volatility, US has asked Saudi Arabia to keep a fixed exchange rate regime so as not to cause panic in the international oil prices. Right? Volatility in the Saudi Arabian real could cause a lot of effect. 3.75. See, it was the same 20 years ago, same now. This is called the fixed exchange rate. It has its merits and demerits. We are not interested in merits, demerits. We are not going to be tested on the dynamics of these systems, how these exchange rate systems work. We just need to know what they are. Just that. I told you your examiner is interested in testing you how these fluctuating exchange rates affect your business with regard to foreign receivables, foreign payables. How would it affect your business, and what tools do we have to protect ourselves against the volatility? That's the key. That's the focus of your examiner. Fixed exchange rate regime, floating. We just need to know fundamentally what they are. The dynamics are not needed because we're not studying economics, are we? So floating exchange rate, the exchange rate that is determined by the market forces. Central banks do not intervene. They let the dollars and rupees play and let them decide what is the $1 worth in PKR. If you allow the dollar and rupee trade freely in the market, the exchange rate that is established by the market forces themselves, this is called the floating exchange rate regime, right? Price can sometimes go up and down. So this is called floating. If you ask me, is there any country where we have completely floating exchange rate? To some extent, but no country in the world has complete 100% clean floating. Central banks intervene. Yes, US is a free market. Yes, US market has close to floating exchange rate regime, but it is not perfectly close. Why? Because many times, Federal Reserve has intervened. As close as 2008 subprime mortgage crisis. Please do search this on Google. Do watch some videos. What happened in 2008? There's a good movie. I hope you remember the name. It was The Big Short. Please watch this movie. You will know what happened. The Big Short. Amazing. This movie will explain in a very fantastic way what happened exactly, Moise, in 2008, subprime mortgage crisis. Now, ideally, if everything is fine, US government should not intervene. Let the market correct itself. But US government intervened in 2008. They loaded 600 billion US dollar under the quantitative easing to increase liquidity in the market, right? So money market should be allowed to act freely, but they intervene. So central bank, they had to intervene. They will have to intervene. You cannot let your currency at the complete mercy of market forces. Things can go extremely wrong, and it happened when? Way back in 2001. Before that, in 1997. Please search this up as well. 1997, Far East Asian currencies crisis. Myanmar, Malaysia, Indonesia, Philippines, 50% of their currency's value was destroyed in a few days. And the man who was directly responsible for this fiasco was George Soros. I hope some of you knows. He's an old man about to die, but he is considered to be the one who was the prime architect of this Far East Asian currency crisis. Currencies lost 50% of their value. So this can happen. Markets, manipulators like George Soros, big hedge funds, they can manipulate currencies. They have lots of money, lots of liquid cash. They can use this cash to swing currencies in one direction or the other, make their gains and they leave. I still remember Dr. Mahathir Mohamad called this man, George Soros, as a moron. And specifically, the word he used was a rogue, a person who is a bad person who just creates destruction. The rogue, that's the word he used, rogue. So this can happen. You cannot allow the market forces to move freely. Someone will have to intervene. Central bank will have to intervene to fix the exchange rate. So the point is then, we don't have complete floating. We have a managed float where, like in Pakistan, let me draw the demand supply curve. Now, way back in 2016-17, when Nawaz Sharif was in government, dollar was trading somewhere between 110 per dollar. Dar Sahib has set a limit that he didn't allow the dollar to go below 95 or above 120. So the dollar was range bound. This is called managed float. You do not allow the dollar to go beyond 120 or fall less than 95. So this is called managed floating. This is done in various ways that is not to be discussed here. But just remember that when the central bank intervenes, it sets an upper and lower limit and allows the currency to trade within this limit. Right. So these are few countries here. Just look at these. These current in dark green color. These are the countries where we have free float or close to free float. Then these currencies, countries with dark blue color, they are the countries where we have fixed exchange rate regime. And those with the light green color, here we have managed float, right? Managed float means the currency is range bound and it trades within the narrow limit defined by the central bank. So that's just the idea to which you need to know. Well, okay, now let us discuss now some computational aspect. Spot rate, some key terminologies related to exchange rate. So these are the three systems. Just brief knowledge is enough. The dynamics, underlying dynamics, they are not required. Spot rate. Spot rate is the number of units of foreign currency received today in exchange for a single unit domestic currency. Let's say you are in the US and the local currency in the US, the domestic currency US dollar. So $1 US gets you 176 rupees right now. This is called spot rate, right? The units of foreign currency that you can get by giving $1 of local currency, this is called the spot rate, prevalent in the market right now. It can be against US dollar or against a basket of currencies. Stronger currencies we have are pounds, euros, and dollars also. So it could be a single currency or it could be a basket of currencies. So gentlemen, spot rate is the rate at which rate at which your currency, domestic dollars, can be traded for a foreign currency right now, today. But there's another rate called the forward rate. We'll discuss it through computation. Forward rate is the number of rupees that you can get in the future at a specific date. Now, let's say this is the rate right now, $1 US is equal to 176 or 175 PKR. Since we are in trouble, Pakistani economy is in trouble, we are expecting dollar to strengthen further, rupee to slide further. So maybe in 60 days time, the forward rate quoted by the banks is $1 is equal to Udana Kwasta, 185 PKR. Right? So this is called the forward rate. The units of foreign currency, Pakistani rupees, that can be received in exchange for a single unit of domestic currency at some definite date in the future. This is called the forward rate. Now, if you just see these two numbers, you can say that dollar is gaining strength in the future. So dollar is being traded at forward premium. Dollar is getting stronger. Why? Because right now, $1 gets you 176 rupees. But in 60 days, $1 will get you 185 rupees. So dollar is gaining strength. Dollar is trading at a forward premium. Whereas conversely speaking, rupee is trading at a forward discount. Let us see how it works through some numbers. Here we go. A currency trader contracts to provide 1.654 Swiss francs in exchange for 1 British pound. Right now, 1.654 Swiss francs per pound. This is the spot rate right now. 1.654 Swiss francs per pound. This is the spot. You can express it in another way also. Like you can take a reciprocal 1 upon 1.654. The number that you will get is 0.6046. Now it is totally reversed. There is pound 0.6046 per Swiss francs, given in the totally opposite order. Remember, 1.654 Swiss francs per pound. That's pound is in the denominator. This is important. And if I take the reciprocal, pounds comes in the numerator and 1.654 comes in the denominator. And if I simplify it, it's a simple maths, it is 0.6046 pounds per Swiss francs. This is the spot. All right. So the currency trader contracts to provide 1.654 Swiss francs in exchange for a single British pound 30 days from now. Today's 30 days forward rate for the pound is therefore 1.6. This is forward. This is the forward rate, sorry. This is the forward rate. And 30 days forward rate is 0.6046 and 1.654. I've just told you how I've calculated. Now, we should be given the spot rate, and I think it is given in the next slide. This is the spot rate right now, 1.652. This is the spot rate. Let me write it down there so as to make it fully understandable. So this is the forward rate. Spot rate is given, and let me write the spots. Spot rate is given as Swiss francs is 1.652 per pound, or written in the reverse order, 1 pound 0.6053 per Swiss francs. This is the spot. Okay, now we can see, just look at the numbers. They will tell you what it is all about. Right now, just take one currency as a reference, Swiss francs. If you give 1 pound, in the future, you get 1.654 Swiss francs in 30 days forward. Right now, 1 pound gets you 1.652 Swiss francs. So what you can conclude, let me just highlight and just try to interpret just these two. This is the rate right now. This is the forward. Right now, 1 pound gets you 1.652. And 30 days forward, 1 pound will get you 1.654. Can you tell me which currency is strengthening and which is getting weaker? Just these two highlighted numbers should help you understand the idea. This is the spot right now. Yes, absolutely. Pound is strengthening. Right now, pounds gets you 1.652. In the future, pound will get you 1.654. Right? So pound is getting strength. Pound is trading at a forward premium. Right? How do we calculate? This is the formula. Let us plug in the numbers and see how it works. So the forward rate here is, the formula is forward rate minus spot rate upon spot into days in a year, which is normally 360 divided by days in the forward period. And you then multiply the result with 100. Okay, here we go. Forward rate is 1.654. Spot rate is 1.652. Divided by the spot, that is 1.652. Multiplied by days in a year, that is 360, and days in the forward contract 30. And whatever you get, multiply it with 100, and what you get is 1.45% positive. 1.45%. That means that pound is trading at 1.45% premium against Swiss francs. If you do the complete reverse calculation, where you take these numbers, these 0.6053 per Swiss francs and this one, you will get negative 145. He has calculated in the next slide, taking the reverse rates, you get negative 1.45. Now, which means that if pound is trading at 1.45% forward premium, that means Swiss francs is trading at 1.45% forward discount. Negative means the currency is losing its value, and positive means the pound is gaining strength. We'll do a few questions that will explain. So this is the formula you would use to calculate the forward premium and forward discount. It's a very straightforward formula, no big deal with it. This is it. Important point that you need to remember is that forward rate, and spot must be in the same order. Like here, I have taken Swiss francs per pound. So Swiss francs per pound for forward and Swiss francs per pound for the spot. And conversely speaking, it could be other way around, pound per Swiss francs. So you should have the same inputs in this side, only then you will get the right answer. We'll do a few questions further that will explain the idea, but this is how we calculate the forward premium and forward discount. So what we can conclude from what we have just done. The conclusion here is given this slide. The implications can be generalized this way. If the domestic currency is trading at forward premium, like your dollar is trading or pound is trading at a forward premium, that means your currency is expected to gain purchasing power. It is going to strengthen in the future, right? If pound is trading at forward premium or dollar is trading at forward premium, mean it is gaining purchasing power. It will strengthen against the counter currency. And on the other side, if your domestic currency is trading at a forward discount, it means it will lose purchasing power. Keep this general conclusion in mind. We will apply it as we move along. Then we have an area called the cross rate, not a science. Most of you, I don't know, are a little confused about it. Let me explain the idea. Let's say right now, $1 is equal to 175 PKR, right? At the same time, $1 is equal to 3.75 Saudi Arabian Riyal. $1 is equal to 175 PKR, $1 is 3.75. I would like to find the exchange rate between PKR and SAR. For this, what I do, I use this formula. Domestic currency per US dollar, I get 175 rupees per US dollar. And foreign currency per US dollar. Foreign currency is 3.75 per US dollar. The base must be the same. If you want to calculate the cross rate, remember in the numerator, denominator, the base currency must be the same. Rupee per dollar and Saudi Arabian Riyal per dollar. Rupee per dollar, right? And pounds per dollar. This denominator here must be the same. The base must be the same, right? So if you do the simplification, let me do it for you. 175 upon 3.75, it should get you the rate that is currently prevalent, that is 46.67. So it means its simplification gives me 46.67. These many Pakistani rupees per single real. 1 real is equal to 46.67. Or you can take any other currency. This is how we can find cross rate. On your exam, things might be given in a little different way. But remember the basic dynamic of this formula. You might be given this, maybe you have to find a PKR per pound. So what you might have PKR per dollar, and you might have dollar per pound. So you should arrange your numerator denominator this way that these dollars are cancelled out and you finally left with PKR per pound. That's what we want. So make sure, just a simple identity. I hope you make sense out of it. PKR per pound is required. So you might be given some currencies in this way. So make the order in such a way. Maybe you are given dollar per PKR. Please listen to me very carefully. Listen to me very carefully. Dollar upon PKR. This is the rate, dollar per PKR, or I might be given pounds per dollar. So in order to find PKR per pound, you need to make an arrangement like this, PKR per dollar. For that, I may have to reverse this, and pound per dollar. For this, I may have to reverse the numerator. In any case, I should have PKR in the numerator and pound in the denominator, so as I can find how many PKR I will get for each pound. This is how you can find cross. It's not a big deal. Asif, the reason I find is that Saudi Arabia is controlled by the US. Once this previous US president, Donald Trump, he clearly said that this guy in Saudi Arabia cannot last for more than a week without our help. US is providing protection to the, yes, they are providing protection to the Saudi Arabian government, and under the American influence, they have kept dollar tied with the Saudi Arabian real so that the exchange rate volatility does not affect the price of the oil. So it's under the force, not by their choice. So they follow what is ordered to them, what is told to them. This lecture is being recorded, which means if it goes in the public, I will never be able to visit Saudi Arabia. I've explicitly said here that Saudi government is under the American influence. So this is under the American influence they have done it. If they allow their currency to flow freely, you will find a very different rate than the current rate. It's under the force, under the American pressure. Okay, now how exchange rate is determined? Through the forces of demand and supply. Let us discuss this. So, as if it is not by choice, it's by force. They are being forced to keep their currency fixed. So that US dollar, now let me tell you why is it so. US purchases oil from Saudi Arabia, and US knows that every time they pay $1,000, it will be equal to 3,751 Saudi Arabian riyal. Whether it is 1999 or whether it is 2029, they know exactly this is what they will pay, and in return, this much will be the Saudi Arabian riyal. So they know exactly what they have to pay. Right? So to fixation of the payments to be made or collected. To bring the certainty in the payments. Okay, now here we go. Look at this. Try to, again, it's not needed, but you need to understand the dynamics of exchange rate changes. Here on the x-axis, we have quantity of foreign currency. Like let's take the example in Pakistan, dollar. And here is the price of 1 unit of foreign currency in terms of domestic currency. Like right now, it's 175 per US dollar. This is the quantity of dollar, and this is the price of your local currency per dollar, right? And this is the current equilibrium exchange rate, and this is the current equilibrium quantity in the market. Now, what happens? There are two sides, demand and supply. Now, just try to make sense how it works. Right now, the dollar is equal to 175. If Pakistani currency strengthens and the rate falls to, let's say, 110 rupees per dollar, what it means, Asif, it means now you have to pay few rupees to get dollars. Resultantly, the demand for US dollar will go up because people here in Pakistan will purchase more and more of American products, right? When the rate falls to 110 per dollar, people will just give few rupees and buy dollars, and using dollars, they can buy lots of American products. And compare it to the situation when 1 US dollar is equal to 250 rupees, 250 per US dollar. At this price, US goods and services will become very expensive. Resultantly, the demand for US dollar will fall, right? So when the US dollar is cheaper, more US goods will be bought. And when the dollar becomes expensive, less US goods will be bought. Now, this is from the point of, remember, demand is from the side of Pakistani consumers. At cheaper rupees, at a lower price, we will buy more of the American goods. But when the dollar goes up, this is what has happened in Pakistan. Many imported goods, even children's milk, it has become very expensive because dollar cost more. We have to provide 175 rupees per dollar. So that's the reason there is less demand for the American goods. Now look at the other side now. This is the side that is controlled by the US, supply of US dollar. Now, when they find that just 15 Pakistani rupees is equal to 1 US dollar, it is not much attractive for for the foreigners, because when they come, they give $1, they get 15 rupees in return. So maybe it's not a good deal. But look at this. When the exchange rate is 190 rupees per US dollar, the Goras from the US, they realize that when they take $1 to the Pakistani market, they can convert into 190 rupees. Using this much dollar, they can buy so many Pakistani products. And this is one of the reasons why we have devalued our currency, so that we can increase our exports. Foreigners will bring in few dollars, but those dollars will convert into a lot of Pakistani rupees, so they can buy more. So in this case, supply will increase. More dollars will come into Pakistan. So this happens. This is how the interplay of demand and supply will establish an equilibrium rate. Right now, the equilibrium rate is 175 per US dollar. So demand is local driven. In Pakistan, supply is from the US side. So when the demand and supply, they balance each other out, this is the point where we have an equilibrium exchange rate, and this is the equilibrium currency in the market. So this is just the dynamics you need to know. An interplay between demand and supply. This is what represents, this is what determines the exchange rate between two currencies. Now, let us discuss the other part now. Now, from this point, you can see why China has the highest level of exports in the world. Why? Because Chinese currency is deliberately kept weaker against US dollar. US dollar, when converted to Chinese yuan, they get a lot of yuan, and these yuans can purchase a lot of Chinese products. That is why China has higher exports. So the point here you would learn that the currency that is weak in comparison, that currency's goods will look cheaper to the outside buyers. Hence, exports will go up. We'll discuss this as we go along. The point we'll discuss forward. Okay, now, balance of payment. I'm sure most of you would have read in your earlier elementary economics. Balance of payment basically is an account of a country's exports and imports over a particular period of time. So let us discuss basic components or construction of balance of payment. Balance of payment, what it is, it's a net of all transactions between domestic parties, your exporters and importers, and parties in other countries. There are two main categories of balance of payment. In the British textbook, you will find three, but let us follow what our textbook tells us. One is the current account. Other is the capital account. What do we have in current account? In current account, we have goods bought and sold, services bought and sold, interest and dividends received from abroad or paid to the outside investors. Vikas is a question. Japanese currency is also less. Japanese currency has smaller denomination, but the people in Japan, they get lots of local currency, which makes millions in Pakistani rupees. So their currency is just like in South Korea, they're won. South Korean currency is won. It is also in smaller denomination. So your salaries is there in millions of wons. And even then, when you convert it into Pakistan, you get a lot of money. So some currencies are kept in a smaller denomination, but still they are strong. Japanese currency is in smaller denomination, but it doesn't mean it is weaker. It's the denomination is small. Okay, now, so the current account of your balance of payment, it involves goods, services, interest, and dividends. Whether you sell goods or buy goods from foreign, you sell or buy services, you pay interest from Pakistan to abroad, or interest received from abroad to Pakistan, dividends paid from Pakistan to foreign investors, or dividend received by Pakistani investors. So it's both ways. All these four items in both ways, it comes in the current account section of your balance of payment. It also includes non-reciprocal transfers. Non-reciprocal transfer means just one-way ticket. Foreign aid comes in Pakistan and in Africa, it doesn't need repayment. You people in Saudi Arabia and Middle East, you sell, you send money to your family as support. It doesn't come back, does it? So it's just one-way ticket. Foreign aid comes, it doesn't go. Remittances to relatives is just a one-way ticket. So all these non-reciprocal means that it's just a one-way. Foreign aid is received, it's not returned. So all these are a part of your current account. Then the second part is the capital account. Capital account involves any Pakistani buying machinery or a plant or a physical land or maybe house in the US, or any American purchasing a capital asset in Pakistan, a building, land, direct fixed investment. or any financial instrument purchased by any Pakistani in the US or any US in Pakistan. So these come in the capital account. So remember, these are the two sections of your balance of payment. And ideally, your balance of payment should have more inflows, less outflows. Means you export more, you sell more goods and services, and you receive more interest and dividends. Your inflows must be more than outflows. Just like in businesses, your cash flows should be positive. You should have sufficient inflows, less outflows. That's the ideal situation. But this is not always. Because in Pakistan, we have, for many years, we have unfavorable balance of payment, means we have more outflows and less inflows. This is what you call the balance of payment deficit. This is chronic, and we are in trouble just because of this. So the point is, when there is unfavorable balance of payment, means you receive less cash for your exports, but you pay more money for importing. Then you will have to borrow. This is what Pakistan is doing exactly. We have a deficit in balance of payment. We have fiscal deficit. And this, especially the balance of payment deficit, it needs to be financed. We borrow money from IMF, and we use that borrow money to settle our external dollar payables. What you buy in Pakistan, what you buy an iPhone in Pakistan, you pay in rupees. Yes, you do. When I purchase an Acer computer, I pay in rupees. But those who have purchased, the traders, those who have purchased iPhones and computers, they pay in dollars. So eventually dollar leaves. Dollar will leave your country when you import. So when you import, dollars will go out, but when you export, dollars will come in. So ideally, your exports must be greater than your imports. This is an ideal situation. But in Pakistan, our imports, in most of the historical perspective, it has been more than your exports. And we have deficits in our balance of payment, which must be funded. We need to keep reserves of dollars, and these reserves will eventually deplete when we make settlement of these liabilities. So reserves depletes. If your exports are less, imports are more, so the country's reserve will deplete. We will use these to settle our foreign liabilities. Bad, that's bad. Now let's see on from the other aspect also. Impact of exchange rates on the balance of trade. I just told you a little while ago, if your currency is weaker against the foreign currencies, your local goods look cheaper. Exactly. Look at this. If the country's currency is weak, like in Pakistan, we now stand at 175 per dollar. What happens now? This is quite an attractive rate for foreigners. They will bring in their dollars. They will get a lot of Pakistani rupees, and they can use these rupees to buy so many things from Pakistan. Resultantly, what happens? Prices are more affordable to foreign buyers. So it has a positive balance of trade. In this case, you can expect your exports to go up. That's what we are seeing. Our exports have now crossed 30 billion, right? So this happens when your currency is weak, your exports improve. Those outside in Pakistan, they find export prices to be attractive, they buy. On the other side, when your currency is strong, let's say, take this, 20 rupees per dollar. When the dollars come in Pakistan, they are converted to few rupees, and those few rupees can purchase just few goods. So in that case, your exports fall, but your imports go up. Now, if this is the case, Vikas, if let's say iPhone cost $1,000, multiplying it 20, I can purchase an iPhone for just 20,000 rupees. So if your exchange rate is strong, your exports fall, but your imports look so attractive that people who were just using Chinese version, they will rush for iPhones. That's a status symbol currently. So this can happen. And this is happening. You can see this happening around. When the currency is strong, 20 rupees per dollar, so you will buy so many imported goods. So the reason why State Bank has devalued Pakistani rupees is just to discourage imports, because the gap between our imports and export is enormous. In order to bridge this gap, they have devalued so that people are discouraged from purchasing imported goods, and imports will become expensive. Our locally made products will become cheaper. More money will come in the form of dollars. So that's the dynamic. You can connect the dots and you will make full sense out of it. Next. Okay, now, one of the reasons that United States has run a deficit of trade every year since 1975 is that the strong dollar has encouraged US consumers to purchase large quantities of imported goods from China, Pakistan, and the rest of the Asian countries. So still, Since 1975, if the US economy is facing deficits, then how are they surviving? How do they finance their uh, balance of payment deficit? They don't have to be worried. Since the world economy is dominated in dollars, oil is traded in dollars, no other currency right now. So they don't have to be worried. Dollar is strong. The moment dollar loses its importance in the international financial system, mark my word, I won't be there by then. America will be in a very serious trouble and it'll go bankrupt. It'll go bust. Dollar denomination and dollar domination in the world has held America together. The moment we have some alternative currency like euro or maybe pound or some other currency, or maybe some Chinese yuan in the future, the moment dollar loses its importance, American government, American culture will collapse. America will become a history. So that's the reason they are not allowing any country to go or trade any oil other than dollars. Dollar is the domination. Dollar is used in international trade. So their domination is what is helping them to sustain. Otherwise, US government is the most heavily indebted country in the world. Just try to look at their outstanding debt based in dollars. So they don't have to be worried because their loan is in dollars, so they can just always print whenever they want. So how do we correct the balance of payment? What we have done in Pakistan, we have deliberately devalued our currency, devaluation through state bank. Remember the difference between devaluation and depreciation. This is done by the central bank, devaluation. Depreciation and appreciation occurs because of the economic factors. So state bank in Pakistan has devalued Pakistani currency, 175 rupees per dollar. What it has done, advantage which we are seeing right now, our exports look cheaper to foreign buyers. And now, first time ever in Pakistani history, exports are above 30 billion. And still it's a shameful number, Faisal, I must say. India exports $50 billion worth of software alone. $50 billion of software alone. I'm not talking about many other products that are sold internationally. But nonetheless, the benefit we have seen, we are a smaller economy comparatively, there's no doubt about that. Our economy has shown $30 billion of export first time in history because of weaker rupee. This is what you see. And what you see on the other side, disadvantages, for those who are iPhone lovers, I am sure they would understand. Imports would become expensive. Now try buying an iPhone in Pakistan. In Pakistan, you have to sell your kidney or part of your liver to purchase an iPhone. It's too expensive. This is one of the reasons, 175 rupees per dollar. Right? So imports would become expensive. And that's why we are seeing a rising trend in jigar ka tukda. Still it's saleable if it could be used by someone for liver transplantation. Okay, so now let's this is an interesting example here. I would like to explain how exchange rate volatility can cause a serious problem for international loan takers. A US company takes a 1-year loan of 12 million pesos at 6.5% to pay a Mexican supplier. After a year, the US company repays the loan with the interest, but in the meantime, the peso has experienced a slight appreciation. Now let us calculate if we take loan in pesos, but exchange rate changes, how would the change in exchange rate can affect this cost of borrowing, which apparently looks quite a nice number, it's 6.5%. Now let us see. When you borrow amount in pesos, you have to give the dollars, right? Or when you take the loan, you convert it into dollars, 12 million pesos. You convert at that date, and the dollar equivalent was 1.105795. Okay. What happened after 1 year? You have to pay interest at the rate of 6.5%. 6.5% of what? 12 million pesos, right? That comes out to be 780. So you have to now return 12.780. This is what you receive. And after 1 year, you have to pay 12.78. But at that time, peso has strengthened against US dollar. Previously, $1 was equal to 92 pesos, 0.92. Now it's 0.94. So peso has strengthened, which means now when you have to pay these many pesos, you have to pay more dollars. Now, if you want to calculate the effective cost of this borrowing, you have to pay 95,525 on the borrowed amount. If you calculate the effective interest rate, we were expecting a rate of 6.5, but because your currency has depreciated over the period, the rate is higher, 8.64. If you compare it in Pakistani context, the things look so frightening that you might be overawed. When we take loan, the rupee was at about 110 per dollar. After 2 years, it goes up to 175 per dollar. Try to calculate the cost of borrowing. It's going to be much higher, maybe 25%. So the loan that we have taken from the IMF, it might be 7%, but the effective cost could be 25%. This could be a very serious issue for a business that borrows in dollars, but because of exchange rate volatility, you end up paying 25% interest on borrowed money. So this is how interest rate changes, the exchange rate changes can make your loan so expensive. Let's do a few questions to understand the concept here. Free fluctuating exchange rates perform which of the following function? Free floating exchange rate. They automatically correct lack of equilibrium in the balance of payment. This is true because if your currency is weaker, your imports will fall and your exports go up. Exports goes up, people keep on, let's say, I would like to explain the idea because some of you might find it hard. Now, let's say right now your currency is 175 per dollar. This is quite an attractive price. At this price, people will demand more of the Pakistani product. When they require more of the Pak products, that means the demand of rupees goes up. When the demand of rupees goes up, the rupee will start appreciating, right? So whenever there is a deficit or a surplus in the balance of payment, free float will adjust the exchange rate in such a way that balance of payment is neutralized. It is nullified itself. Since we don't have a free floating exchange rate, so we have to make some intervention by the State Bank and by the IMF. So remember, in a freely fluctuating exchange rate, balance of payment deficit and balance of payment surplus, it is corrected automatically by the exchange rate movement. We don't have to intervene. We don't have to do anything. What about the other options? They make imports cheaper and export more expensive. Not necessarily. It could be other way around also. They impose constraints on the domestic economy. They don't. Free floating exchange rate does not constrain the domestic economy. Rather, it facilitates free flow of foreign currency in and out of the country. Free market forces. You are not restricting the free flow. They eliminate the need for foreign currency hedging. Free float means exchange rates will move up, down, keep on moving, keep on changing, which means you are exposed. You need protection. So in this case, you will need more currency hedging, not less. I would say it would require more hedging because the currency will be quite volatile. So that's why D is not the right answer. If foreign currency markets, the phrase managed float refers to what? Hedging, Asif we discussed in our previous classes, hedging is a protection against exchange rate movement. Like, for example, let me give you an idea. I have to pay $10,000 maybe in 3 months. And right now, exchange rate is 175 per dollar. And seeing the things around, I expect that maybe exchange rate can go up to 200 rupees per dollar. What can I do? I can't expose myself to such a huge risk. What I do, Asif, I make a hedging arrangement. I go to a banker, right? Like Fahim is a banker. I go to banker Fahim. I ask him that I want to purchase dollar in the future. So book a rate with me right now. Let us fix a rate right now. Foreign exchange forward contract. So Fahim will ask for a 3% commission and he will enter into a contract with me whereby he will provide me $10,000 at this rate at 3 months in the future. This arrangement is called hedging, where I protect myself from exchange rate volatility. So we will discuss this in detail in our class, maybe the day after tomorrow. What are the tools we have? So we have some tools how we can use, how we can protect ourselves against the exchange rate volatility. Money market hedge, we have options, we have swaps, we have forward contracts. We'll discuss them. Next, in foreign currency markets, the phrase managed float refers to, managed float means intervention by the central bank, like Pakistan, State Bank of Pakistan, Reserve Bank of India, or Federal Reserve in the US. They intervene in the market to fix the exchange rate within the narrow band, right? So tendency for most currencies to depreciate in value. This is not free managed float. It is the discretionary buying and selling of currencies by the central bank. How central bank controls exchange rate? It is through discretionary buying and selling. Let's say if the central bank wants dollar to depreciate in Pakistan, central bank can sell lots of dollars in market. $5 to $6 billion can be thrown in the market. There will be so many dollars in the market that demand of dollars will fall, supply will increase, resultantly the dollar will depreciate against Pakistani rupees. And if we want the dollar to appreciate, state bank, central bank will start purchasing dollars from the market. So buying and selling of currencies in the market can increase and decrease the exchange rate. This is how central banks devalue or revalue the foreign currency. This is true. This is called managed float, and this is what is being done almost in every country. To some extent, some do frequently, like we keep on playing. Our central bank keeps on playing with dollars. And whereas in the advanced countries like in Canada, US, and the UK, they intervene only when the situation is alarming. Otherwise, they don't. Necessity of maintaining a highly liquid asset such as gold. Gold is no longer a part of the financial system. This is totally history. 1973, under the Bretton Woods Agreement, gold is no longer the basis of currency valuation or the currency printing. Fact that the actual exchange rates are set by private businesses is wrong. Exchange rates are not set by the private businesses. Rather, it is set by the market forces of demand and supply. Wrong. One may characterize the current international monetary system developed by the industrialized countries as the current international system. What system do we have? Is it clean float? No, it is not. It is not clean float. Even in advanced countries, US, Canada, UK, we still see central banks intervening. So this is wrong. What we see is managed or dirty float. Dirty float is an alternative term because when the governments do not allow the exchange rate to settle freely, they intervene. Sometimes it's called dirty floating. So central banks intervene in the foreign exchange market to influence the exchange rate, just like in Pakistan. If the US dollar peso exchange rate is $1 for 9 pesos, a product price at 45 pesos will cost a US consumer what? I would recommend you people to use this simple arithmetic to solve exchange rate related questions. Simply write the currencies that are involved. We have dollars and pesos. This is dollars here. This is pesos here. It says 1 US dollar is 9 pesos. If we have to purchase an item that costs 45 pesos, how many dollars will it involve? Simply make a cross. 9x is equal to 45. It's a very elementary maths. You might have done it in your maybe 7th or 8th grade, but it will nonetheless help you. You will always get a right answer. X now is $5, so that will be B. Right? So you can do it anyway, but this is a convenient way, which is always suitable to do any calculation. You won't get it wrong. Let's try it again. A US firm can buy 20,000 pounds by giving 100,000 US dollars. Now, if this is so, the rate of exchange for the pound is rate of exchange for pound. Now, what we have to do, we have to, here most of you will get confused, the rate of exchange for the pound. Now, the question is, should the pound be in the denominator or should the dollar be in the denominator? That's the question. Should the pound be in denominator? This is the rate of exchange for the pound. If I take this X and this 1, please focus what I'm going to do. Make a cross. It's going to be 20,000 is equal to 100,000 X. This will give me, and remember this is representing here pound and this side is in dollars. If you simplify, it will be 20 by 1,000, that's going to be 0.2. So pound 0.2 per dollar. Pound 0.2 per dollar. Do we get anything like that? We get $0.2 per pound. So the question says we need to find dollar per pound. So this is not the right calculation. Remember, it is either pound per dollar or dollar per pound. Look at the options here. It is dollar, these many per pound. So you have to reverse your calculations. And what you're going to do now, you're going to put X here. Let me write in the other color, X and 1 here. Now it's going to be 20,000 X. And 20,000 X means you're talking about pounds. And it's going to be 100,000 into 1, which means if you simplify, it's going to be 100,000 divided by 20,000. It's going to be $5 per pound. This is basic arithmetic, but please make sure you don't make a mess out of it. There is always a base currency and the counter currency. So remember, it's either dollar per pound or pound per dollar. So you need to see what exactly is the requirement of the question. So it is dollar per pound. So that's going to be B. Right? Okay, next. $1 is being quoted at 100 Japanese yen. Okay, this is the current rate. Remember, here I'm going to write 100 Japanese yen per dollar. This is the right way to put it. And on the spot market, and 102.5 Japanese yen on 90 days forward. So this is spot, and forward rate is 102.5 Japanese yen per dollar. This is the right way to write it. You won't make a mistake in this case. Now it says Japanese yen at 90-day forward. Hence, the annual effect on the forward market is that the US dollar is, we know the formula, it's equal to the forward rate minus spot upon spot into days in a year, which is 360, divided by the days in the contract, 90. Plug in the numbers. This is the forward rate. This is the spot rate. If you do the calculations, it's going to be 102.5 minus 100 upon 102.5 multiplied by 360 divided by 90, and whatever you get, you multiply it with 100. It's about, I think I made a calculation, Mr. 102.5 minus 100 upon 102.5 times 360 upon 90. It's about 10%. 10% premium. The result, if the result is positive, that means it's premium. If the result is negative, that is going to be a discount. So that makes A to be the correct option. Again, assume the spot rate of the Canadian dollar is 0.9. If the spot rate 1 year from now is 0.85, the Canadian dollar will have depreciated by what? Now, again, you will have to first establish how the rate has been given. The spot rate of the Canadian dollar is $0.9, means $0.9 per Canadian dollar. This is it. And here again, it is $0.85 per Canadian dollar. So in the denominator, we have Canadian dollar. So let us plug in the numbers now. We need to find out the forward rate. We know the rate forward minus spot upon spot into days in a year divided by the days in contract. Have we? No. 1 year. That means straight 360. 360 in the numerator, 360 in the denominator. Plug it in. Forward is 0.85. Spot is 0.90. Again upon 0.90 into 1. Whatever the result is multiplied with 100. The result is negative, clearly. That means depreciation. 0.85 times 0.9, 0.85 less 0.9 upon 0.9. That is about 5.55%, which is 5.56 negative. So it is depreciated by 5.56. That makes B to be the correct option. So I told you in the forward rate calculation, whether it's a premium or discount, if the result is positive, that is premium. And if the result is negative, that is discount. It is not over yet. We have still some good quality questions remaining, maybe 10 to 12 questions. We will do these tomorrow with this class, with this unit, and then we'll move on to the next topic, because Forex area is little twisted. There are some twisted questions that will require some understanding. Once we do, then we will move on to the next topic, inshallah.